Debt Market Update, June 2021. The fixed income markets traded within a narrow range in June 2021, with 10-year G-Sec yields ending the month at 6.05%, up 3 basis points compared to May 2021. The movement in yields was influenced by dovish commentary of RBI and announcement of GSAP 2.0 of INR 1.2 lakh crore, range-bound movement in treasury yields, etc. While the CPI came in higher than expected and oil prices also continue to inch up, the impact on the 10-year yield was relatively lower on account of continuous RBI intervention. The average net interbank liquidity surplus was relatively stable compared to last month despite being a seasonally weak month. This was supported by liquidity infusion by RBI through GSAP 1.0 for forex purchases by RBI. Net FPI flows in debt turned negative to $0.5 billion during the month from being marginally positive in May 2021. Cumulatively, in Q1 FY22, FPI's net outflows into debt stood at $0.2 billion compared to net outflows of $3.7 billion during Q1 FY21. Outlook. The MPC minutes released by RBI for its June 2021 meeting were largely in line with expectations. Most of the members expressed concerns over GDP growth owing to resurgence of second wave of COVID-19. The members also expressed their concerns on higher than expected inflation prints. However, they acknowledged that the current spike is attributed largely to supply-side disruption and hence can be transitory as aggregate demand conditions remains weak. Since early 2021, the overall environment has turned adverse towards yields. Rise in crude prices, surge in 10-year US Treasury yields, higher than anticipated government borrowings, elevated CPI and core CPI, etc. are likely to sustain and keep upward pressure on yields, especially at the longer end. Additionally, high SLR holding of banks and signs of improvement in economic activity can also push yields higher. Further, with June 2021 inflation print surprising on the upside, can result in RBI deliberating on calibrated withdrawal of liquidity, which can put pressure on risks to the shorter end of the curve as well, and thus reducing the term premium to a certain extent. To counter these factors, RBI has proactively kept liquidity in large surplus and kept benign financial conditions. Further, it has also often intervened through unconventional tools like LTRO, TLTROs, GSAP, OMOs, Operation Twist, etc. These measures have been effective and it has been able to stall the rise of 10-year G-Sec yields despite multiple adverse factors. The dovish commentary and future guidance, coupled with systematic liquidity infusion done by RBI, indicates that these interventions will continue in the near future. This should keep yields from rising sharply, especially at the medium to longer end. Further, comfortable external position, muted credit growth, ample global and domestic liquidity, weakness in growth due to second wave of COVID-19, etc. can also cap sharp rise in yields. In view of the above, we expect yields to trade with a marginal upward bias at the medium to longer end of the curve, while yields at the shorter end of the curve can rise at a faster pace. Thus, we continue to recommend investments into short to medium duration debt funds, preferably in a staggered manner in line with individual risk appetite. The credit environment still warrants caution. Measures undertaken by RBI so far have eased the spreads on AAA-rated bonds significantly, but opportunities continue to exist in select pockets of non-AAA-rated bonds as credit spreads are still trading at attractive levels. Hence, Allocation to credit-oriented schemes or funds with some non-AAA exposure can be maintained or increased in a phased manner in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.